So we've been focusing on production up until now. We've been very focused on what happens inside the factory. And so in this video and what follows, we're going to start to look at the other side of the equation, which is the circulation of capital. And that's going to involve a discussion about what capital really is, and what exactly are we talking about that's circulating. And then after we're done with that, we're going to put it all together and do the thing that I actually said we were going to do at the end of the last video. I guess what's really happening at this point is I'm kind of moving backwards through the volumes of capital. I started at the beginning of volume 1, and then I jumped to volume 3, and in this video I'm going to summarize the first two parts of volume 2 basically, and then in the next video it'll be kind of like the third part, and then we will finish up with the climax of volume 1, I guess, is kind of how this is turning out. But in any case, let's get started. So if you went up to a capitalist and you asked them, what is capital? They'd probably say something along the lines of capital is money. If you got a more sophisticated capitalist, they might say something along the lines of the capital is some kind of asset valued portfolio, right? Money, stocks, stuff like that, just a collection of things like money. But basically the answer they would give you is that capital is a thing. It's either like money or it's a money-like thing. But we know that not all money can be capital. If the capitalist spends $5 and buys a hot dog, or spends $60 and buys a video game, and you ask them, was that capital? They'll tell you, no, that was not capital. And so we have to admit that they didn't give us the full story when they told us that capital was money. Therefore, we have to assume that capital is money being used for a particular purpose. And of course, we know what that purpose is. It's I'm using capital if I'm a capitalist. And if I'm a capitalist, I'm pursuing profit. So capital is, at the very least, to the extent that capital is money, it's money that's being invested in a way into a process that will eventually produce more money, profit, right? And we know that to create profit is to create surplus value. And so we know something else now. We know that capital, to the extent that it's money being used to create surplus value. Now, what's the process of creating surplus value? The process of creating surplus value is that I bring some money to market, I buy labor power, I buy raw materials, I use them in a process of production, I create new commodities, I take those new commodities to market, and I exchange them for money at hopefully a profit. That process is what we're going to define as capital. Capital is that flow of social activity. And of course, money being used as capital is deeply related to this process. Let's think about how exactly it's related. By the labor theory of value, we know that money now is essentially command over some portion of the social product. If I have $5, then I have $5 representing a claim essentially over the output of society. I can claim $5 worth of whatever society produces. That's one way that I can spend my money. But I can also spend my money in such a way that I use it to create a social process. I can use it to create a production process. And in that sense, I'm sort of using money, I'm sort of waving money around as a baton in order to coordinate production and put in motion a social activity in which people come together at a central location with raw materials and they produce things. So capital is a social process, and as a social process, it's put into motion by money. Money is like the conductor's baton that creates that coordinates people and things to create more things. And personally, my definition of capitalism as a mode of production is it's the mode of production in which the predominant form of how society produces its daily product is capital, the capital social relation. That's my personal definition of capitalism. And as the defining social process of capitalism as a mode of production, it needs to be able to reproduce itself. And indeed, we see that. Capital as a flow is essentially like a network of flows that are meant to kind of recreate each other. And with that said, this is probably as good a time as any to introduce Marx's kind of famous diagram of capital as a social relation. Let me show you that. So Marx's kind of famous diagram goes like this, in its kind of most expanded form. Basically, you start with money, which he denotes M, and then you take that money to market and you trade it for commodities. This is all stuff we've already known, but I kind of wanted to show you the diagram as Marx writes it. You trade that money for commodities, and as commodities, what you really have are two kinds of commodities. You have labor, which he denotes L, and you have, I've been calling it raw materials, but he calls it means of production, which he denotes MP. And then this labor and means of production are brought together in the production process, which he denotes like ... P ... where the ... dots basically denote time elapsing, because the whole point is to use up the worker's time, right? So time there's a time span here, and I think that's important to capture, and I'm glad he does that. But at the end of the production process, what you have is a new set of commodities, which he denotes C prime. And then you take that new set of commodities to market and you sell them to other capitalists and workers. And that gives you a new amount of money, M prime, which, if you are lucky, is M plus some amount, some new amount, some profit, delta M. But then what you can do is you can restart that process. This M is then taken and it is spent on commodities, that is to say labor, power, and means of production, and then that is used to create the production process again. And you can even take this delta M and you can kind of make the process bigger next time. And so this is a social process that can recreate itself. This is a social process that reproduces itself, as long as all of the other social processes also reproduce themselves. So you kind of have to have a lot of things going right in a lot of different versions of this flow all at once. And so that's capital. What we call capital is really a circulatory flow of social activity. Money put into motion as capital creates and directs these flows. I really do want people to think about capital as like a fluid, as like a flow of social activity. You can almost imagine like an invisible, like floating liquid that kind of goes through everything in like a chronological span of time, that goes through everything, possesses things, possesses people, possesses objects, and kind of animates this social process. And the like aggregated network of all of these social processes is like this complex web of different flows, almost like a river, almost like a river system. And money interacts with this in really like two key ways, I think. I can use money to basically have a say in what this flow looks like. I can direct the flows with my money like a conductor's baton. Although we'll see by the end of this video that their ability to direct the flows however they want is very limited and probably diminishing over time. I can also cash in and use it to basically siphon off goods and services from this flow. And then labor's relation to this flow is interesting too. If I'm a worker, I kind of sell myself to the flow, put my labor power into the flow to kind of push it and make sure it moves. It's almost like this flow is actually powered by real physical work, like workers like swimming against it and creating the flow in kind of the opposite direction. But that's capital. So with all that said, we're now in a position to be very, very clear about what we mean when we talk about capital accumulating. When I talk about the accumulation of capital, I am not simply talking about the accumulation of wealth. I'm not talking about the accumulation of stuff. I'm not talking about the accumulation of things or value of those things. When I say that capital has accumulated, what I'm saying is that the scale of social production has increased. If I say that there's more capital on day 2 than there was on day 1, if I'm saying the capital has accumulated from day 1 to day 2, then what I'm really saying is that more people are doing more labor, they're using more raw materials to make more stuff, that the process of making stuff has like gotten bigger. They're trading more stuff for more raw materials, they're doing more labor, there's more people involved, there's just more stuff happening. More of all of this is happening. That's what it means for capital to accumulate, because capital is the social process. It's not the output of that process. That is an accumulation of sorts, but it is not an accumulation of capital. When I talk about the accumulation of capital, I'm talking about the buildup of social activity, the scaling up of daily social productive activity. And so this is what I meant. To kind of return to this picture, this is what I meant when I sort of called this flow and this flow, the flow of capital goods and the flow of wage and consumer goods, when I said that the thickening of these two lines, which represents the accumulation of capital, was the accumulation of capital, but this escape valve, the mansions that are made for the capitalists, the bombs that are made to blow up other countries and stuff, this escape valve is an accumulation of sorts. It's an accumulation of luxuries and objects and things, but it's not an accumulation of capital. It's not the subject of this video. The subject of this video is the productive process itself and the way that thing scales up. And so that's really the subject of kind of the remaining videos in this series. We're going to be talking a lot about the circulation of capital and the accumulation of capital. This first video will be kind of more on the circulation of capital, and then we'll kind of build into the talking about the accumulation of capital. And then once we do that, we'll be interested in, we'll be starting to talk about, we'll start to talk about it in this video too, but we'll be starting to talk about kind of what else is going to accumulate, and furthermore, what else is going to circulate as this process develops. One more thing before we really get into it is I want to be very clear about what I mean when I say a capital. So I'm going to be talking about capital, and when I talk about capital, I'm kind of talking about capital in general, like what is capital doing as a whole. But when I talk about a specific capital, individual capitals, what I'm referring to are like fixed particular processes of production, like a single steel producing firm, or a single game developer making video games, or a single restaurant serving food to people. And I can talk, and each of these capitals kind of has its own size. I could speak of the size of a capital. And when I do that, what I'm really talking about is, of course, the daily cost of operation for that capital, right? There's a cost required to animate that social activity. And this cost is very real. Right? Remember that these daily costs that I'm talking about are times. There's amounts of time. And so what the C plus V number represents is it's the necessary amount of time that is required to spend every day in order to keep that flow of capital going. Right? How many man hours are going into this the upkeep of this capital? That's the size of the capital. So to start, I want to talk about a few different aspects of this accumulation process that are going to be worth considering as we go. First of all, there's what Marx referred to as capital concentration, which is what I'm just going to kind of refer to as accumulation generally, and which I think kind of should be thought of equivalently with accumulation generally. Concentration is these lines thickening, as we discussed. The reason that Marx comes up with the word concentration to use in place of this is because he wants to talk about two other aspects of the accumulation process which affect the rate of accumulation. And those two aspects are the repulsion and attraction of capital, respectively. So the first of these is the tendency for individual capitals to split into smaller capitals. So the example that Marx gives directly is inheritance, right? So one great captain of industry kind of dies, and then he leaves as inheritance his capital to his various sons and daughters and so forth. And so that represents kind of a splitting of capital between those different people, and those will start to develop independently of each other. They might even develop into like competing empires to some extent, right? So that's one way in which capital can split. Another example that I thought of is franchising, right? You have a restaurant, and then you decide to open up a couple more restaurants, and then you want to kind of even go further than that, and you start to allow for other people to kind of borrow some of your capital and then use it to basically start their own versions of your business and pay rent to you, but those are independent capitals kind of splitting off. And so what we see in either case of this is a general kind of slow growth of the capitalist class itself. So as capital concentrates, individual capitals has a tendency to like repel from each other, to split off into smaller capitals. And this splitting process always kind of corresponds to a growth, however slowly, of the capitalist class itself. So while it's questionable the extent to which this actually affects the rate of accumulation, I'm really not convinced that it affects it much at all, and I think Marx agreed with me. It is noteworthy as to note kind of in advance, before we get too far, that there is this dynamic that accompanies accumulation in which the capitalist class does kind of grow at a slow rate. Now, what we're going to see is with this other thing called centralization, which is going to be a much greater force of the dynamics of capitalism, the capitalist class is going to shrink. And that shrinking is going to kind of overpower any kind of accumulation of the capitalist class itself. But it's still worth noting that there is this other process happening at the same time. Now, what we're all extremely familiar with is the opposite tendency, centralization. So by the centralization of capital, I mean the tendency for capitals to do the opposite of repulsion, to like kind of attract each other and then kind of like congeal into one big blob capital that's kind of, the sum of the two. The social form that this takes is, of course, mergers, buyouts, takeovers, acquisitions, etc. And then another thing that I didn't write here is the formation of things like cartels and trusts, where you get so much centralization that entire sectors of industries end up falling under like a single like nexus of control, right? You get this one kind of group of people that essentially control the entire supply chain for this entire industry, and just control an entire chunk of the economy. That's kind of the final stage of centralization that we tend to see. And we're all very, very familiar with this as a very core feature of capitalist society, especially in the modern age. But what we're maybe not so familiar with is the fact that centralization of capital does very much affect the rate of accumulation. And in fact, what Marx argues is that the more that capital centralizes, the faster accumulation happens. In fact, and the reason for this basically revolves around an aspect of productivity that we haven't really covered yet, which I maybe should have covered already, which is that the productivity of labor is going to scale not with centralization, but with the scale of production itself. A factory doesn't work unless I've started as a preliminary with the idea that I'm bringing a lot of people together. The more people that I bring together into one productive process, the more I can organize them in complex ways. And so the social organization of labor is every bit as much, if not more, a factor in productivity as the level of technology. If you put more workers together, then you're going to be able to be more productive with those workers. That's kind of a general principle that Marx puts a big emphasis on, and maybe I should have put a bigger emphasis on as I did these videos. Now, this produces an interesting dynamic independently of any kind of crisis theory, which is that if this is the case, if it's generally the case that the more workers you put together in one production process, the more efficient you can make that process, then it's going to be the case that larger capitals are generally more productive than smaller capitals. The bigger production processes are going to have just kind of like a technological, not a technological, but a productivity advantage over the smaller ones. So to think about this in terms of the labor theory of value, you've got two things going on at once. You've got that the larger capitals are, one, occupying a greater portion of the market share, and two, they are producing things at a lower labor time than other firms, than the smaller capitals. And so if that's the case, then that's going to skew the socially necessary labor time. The average labor time is going to drop below the level at which other smaller capitalists are able to produce that commodity. And so they're going to be producing at a bit of a loss, and the bigger capitals are going to be producing with a bit of super profits. And so what you have is like a permanent bias in favor of the larger capitals, just kind of naturally. They have a natural competitive advantage just by the fact that they have, one, more market share, and two, more people to organize in more efficient ways. And this is going to basically create a tendency towards centralization that's independent of any kind of crisis of capitalism. The bigger capitals find themselves with a general competitive advantage, and the bigger they get, the more that advantage grows. Furthermore, as technology develops and the size of these larger capitals gets bigger, barriers of entry are going to get higher and higher, right? If in order to kind of produce a product at its like maximum productivity requires bringing together hundreds and hundreds of thousands of people, maybe, then there's just no way for a smaller capitalist to kind of jump into this industry. You can't just enter an industry with 10 cents. You've got to bring a large amount of operating capital, especially in these bigger industries. And so these smaller capitalists, to the extent that they exist at all, they're going to find themselves operating on the periphery. They're going to fill in smaller niches, right? If you decide to be a capitalist, and you might be able to get a loan from a bank to like start, some kind of arcade or bar or restaurant or something like that, but you're not going to be competing with Amazon, right? You're not going to be competing with Microsoft. You're going to be doing something that they deem not profitable enough to even bother thinking about. And this is why. Because there's been this general kind of trend towards capital centralizing, right? Especially in the bigger, more important industries. And so in the long term, these smaller capitals have a tendency to shrivel up and disappear. And so by disappear, of course, we mean being absorbed into the orbit of bigger capital. And so that is Marx's general argument for even why, outside of any kind of theory of crisis, centralization is going to have a very strong pull. A pull that gets stronger over time as capitalism develops. And I think it's a very compelling argument. And another interesting thing that you sort of get out of this centralization argument that I should probably bring up at this point is sort of the emergence of this big division within the capitalist class itself. You're starting to see more and more this division between the big capitalist, right? That's in charge of the centralized capital, and the small capitalist, the petty bourgeois, right? So you've got sort of a big bourgeois and a petty bourgeois that are very much separating in a way that is qualitative and not just quantitative. Remember, we want to think about class independently of income brackets. Well, right here we're starting to see the emergence of something like a middle class in between the laboring class that has to sell their labor and the capitalist class that is like in charge of the big capitalist. We're starting to see more and more of like a qualitative distinction starting to emerge between a big capitalist and a smaller capitalist. I don't want to have an argument or try to make an argument about whether or not you should consider this its own class, but I think that it's undeniable that there is kind of a qualitatively different emergence happening here. There's something happening that is separating out these two groups, and in some sense maybe even pitting them against each other. So we've talked a lot about what it means for capital to accumulate. Now let's talk a little bit about what else is going to accumulate as capital accumulates. And the most obvious kind of immediate answer to that question is obviously money. And when I talk about money here, what I'm really specifically talking about is like money as a use value. Money is like things that people carry around and use for specific purposes. Now, obviously, money is kind of less of a thing to some extent than other commodities, but it is still kind of a use value. It is still something that circulates. It is still a thing that people kind of obtain and use for specific reasons. And as a use value, it sort of has two kind of functions in society. So one of those uses is as a measure of value. In kind of our naive labor theory of value, like equilibrium economy, it tells you essentially exactly what the value is. It just kind of gives you a number that tells you how much labor went into it in some unit. In a real society, it kind of encodes a bunch of information. It encodes information about the commodity. It tells you something socially about the commodity. What it tells you is complicated, but it does give it essentially labels the commodity with a number that encodes information about it. That's how we've been mostly talking about it, but it's also got another purpose. It's a means of exchange. It's meant to facilitate and streamline trade. And to understand this, suppose you have something that I want, but I don't necessarily have something that you want. Somebody else has something that you want. So how do we both get the things that we want? Well, we could find that other guy that has the thing that you want. But if neither of us has something that guy wants, then this chain could end up going back even further. We might have to find a fourth guy. And this could go back forever. So without something that kind of acts as a middleman to kind of facilitate the trade of these commodities, this could be very, very complicated. You kind of need something that is a universal, something that everybody wants, something that kind of can be used as like a universal token to facilitate trade. If you have a society in which market-based trading is like the general form of how things are done, you need something like that at that point. You can almost think of it as like a stream of water, like the commodities float along. Like the stream of money flows one way, and then commodities kind of float the other way down that stream. Because if I trade money with you for a commodity, then like the money goes one way and the commodity goes the other. So I almost think of it as like a river, but it's sort of like an opposite day river, where the water flows in one direction, but the commodities flow in another direction. But nonetheless, it kind of, as a river, it facilitates like transport of the commodities. The commodities can float along the river, and people can interact with the river in like a designated way and grab things onto it, or grab things off of it and put things onto it when they want to put things onto it. It acts as a stream that commodities can float along. However, as a stream of water, in order to properly function, it needs to flow. And so there's a problem here, which is that people can take the money out of the stream, and they can just keep it. They can hoard money, and they're going to be incentivized to do this because money, as soon as it becomes this kind of universal, it becomes something that everybody wants. It becomes something that people become fixated on. If I have money, then I can have anything, and so I want lots of money. And so people are going to try to save their money. They're going to try to hoard their money. And if you have too much hoarding of money by too many people, then this can actually disrupt its ability to act as a means of exchange. But before it even manages to completely disrupt money's function as a means of exchange, if the river just dries up but commodities can still float along it, well, then what's happened? Well, money as a thing, its supply has gone down. Now, it's kind of weird to talk about this because money isn't really a particular commodity anymore like gold, but you can almost kind of say that if the supply of money dwindles, then the price of money goes up, which sounds weird, but it makes perfect sense because you can see why this is going to disrupt money's ability to act as a unit of time. It's going to disrupt the ability for money to properly measure the value of other commodities. If I tell you that like this clock is worth $5, I'm not explicitly referencing time anywhere. I'm basically saying that I have this clock and it's worth 5 of this other commodity called dollars. If the value of that other commodity that I'm measuring everything in terms of goes up, then suddenly that clock is going to be worth less than $5 because $1 is worth more. And so as a unit of time, to the extent that money can function as a unit of time, if the money supply dries up at all, then it becomes a different unit of time. As a unit of time, it is no longer stable. It is no longer actually measuring value. And so that's a big issue. And it should be noted that this is actually true even without a labor theory of value. To the extent that money codes information at all, if you don't have a stable, if you don't have something whose like value or trade, if you don't have something whose exchange value is stable, then it fails to actually code any information. It's a leaky channel at that point. So the measure of value and the means of exchange, these two kind of purposes are in contradiction with each other, because the means of exchange creates an incentive to hoard, and that incentive to hoard disrupts money's ability to properly measure value. And so a new social necessity arises out of this. The social necessity of maintaining like a societal hoard of money. If everybody's hoarding money, then you need to kind of, as a society, organize like a centrally administered hoard of money. You need in order to inject liquidity into your stream of water. Your stream has to be like flowing, with the same volume and the same velocity at all times. And so you need a bank to do this. You need a central hoard of money, and people that are willing to kind of inject more money into society when it's necessary and pull money back out of society when it's necessary. And this takes the form of a bank. So this is where the social necessity of like a banking structure arises, and you get banks starting to pop up all over the place. And just to be very clear, like what I'm saying is not historical at all. I'm not saying anything about the development of money. I'm simply saying that if you have a society that is in a trading relationship like this, money is a social necessity. That's all I'm really saying. And this is why. This is like the function it serves in that kind of a society. The history regarding where money comes from and how it develops is complicated, and it can be very different depending on the time period and the history of the society up to that point, right? All we're saying is that it is a logical necessity in a society already like this. The kind of central takeaway for us is that you have this reserve hoard of money that's necessary for society to function. Furthermore, as capital accumulates, you've got more and more commodities kind of being traded in the market, right? Part of the process of capital is trading commodities in the market, taking commodities to the market, trading them for money. If you have more and more of this happening over time, then that hoard of money has to grow. So what else is going to accumulate? Money. And by money, what I really mean is this like central hoard of money. The banking system, the money supply has to grow as well. It has to accumulate as capital accumulates. So to summarize, as capital accumulates, greater and greater masses of commodities are being traded, and so this necessitates a greater and greater amount of money being put into circulation, and also, just as importantly, a larger and larger hoard of money on reserve to be mobilized whenever it's necessary to stabilize money as a measure of value. So, I mean, in an age of fiat currency like what we're in, where the Federal Reserve just makes up money and money isn't attached to any particular commodity, the idea of a money supply is strange and abstract, but I think it still applies in the sense of like a cybernetics problem, right? I mean, where does the Federal Reserve, the Federal Reserve can make up money, but where does it send that money? Who gets it and why, right? I mean, you have to kind of you're still flooding the market with numbers, right? You're still coordinating something and basically simulating an increasing money supply in this way. So, the argument applies, it's just more abstract here. Now, at this point, something really interesting happens. Keep in mind that money being used this way, as a measure of value and a means of exchange in a society that's doing some heavy trading of commodities like this, and a lot of things are being produced as commodities, that doesn't necessarily have to happen in only a capitalist society, right? You have merchant republics and feudal economies as well. There are pockets of society in more than just capitalist society where you have something like money being used this way. And so the social necessity of some kind of centrally administered hoard of money applies to other modes of production, at least in pockets like merchant republics where you have this kind of thing going on. And what's interesting is that at this point, you have the social necessity of a capitalist class, because who's running these hoards of money, these things that seem like banks? Well, whoever's running it, they are staring at money and they're using it in a completely different way than the people that normally use money. Money as a means of exchange looks a particular way, and to understand what money as a means of exchange looks like, let's go back to Marx's diagram. So here's the circuit of capital, and it starts with M and it ends with M. Money as a means of exchange looks very differently. What I've been describing is a process by which you start with a commodity that you want to trade, and then you trade it for money, and then you trade that money for the other commodity that you wanted. CMC. That's money as means of exchange. I go out with my commodity and I want to trade it for another commodity, and money exists as a middleman to help streamline that trading. If I'm a banker, what am I doing? If I'm a banker, I'm inserting money into the population and then pulling it back out. So it looks like this. I'm taking money and I'm putting it into circulation, and then I'm pulling it back out of circulation. If I'm putting it into circulation, chances are I'm doing something with it. I'm spending it on something. I'm doing it kind of arbitrarily to stabilize the money supply, but there is some kind of thing in between that is not money. I'll just call it C. And so we get something that looks a lot like capital right here, MCM. And it's completely paradoxical to stare at, because why would you do this? You have the social necessity of something like this, but there's no reason to do this if the money you get back is simply the same amount of money that you started with. The only way this is going to kind of arise naturally is if there was a way that you could get back something extra, right? Some extra amount of money, M plus delta M, M prime, some new thing. So there's a few conclusions that I think are worth making from this. One is that in a pre-capitalist society, you can sort of see now, as commodity production and trading for some kind of muddy commodity becomes widespread, you start to get the capital social relation, this odd M to M kind of relation forming in embryo. It's at least forming an embryo with respect to the social necessity of some kind of banking structure. That's one way to think. That's one thing to kind of see from this. Another thing to see from this is that it makes very clear that the capital social relation is completely asymmetric to how normal people interact with money. If you're a worker, what are you doing? You're taking your commodity, that is to say your labor power, and then you're selling it for money, and then you're taking that money and you're selling it for your means of subsistence. And so it's a CMC relation that you're primarily engaging in. If you're a capitalist, you're engaging in a completely different kind of thing. You're engaging in an MCM relationship. This is the capital social relation. So really, when I said that money has two purposes, two use values, I was lying. It has two use values, and then it also kind of creates for itself, out of the contradiction between those two use values, a third use value, which is capital, which is money as capital, money as an MCM kind of thing. So I'm adding this in later. That's why this whiteboard thing looks different and everything looks different, and I can't hide anything, and it's annoying. But anyway, I wanted to add a couple of things to this conversation about money. One is that there's ideological consequences to the fact that you're engaging with money as a completely different social relation as a worker versus if you're a capitalist. If my relationship to money is a completely different social relation, if I'm a capitalist versus a worker, then that just kind of enforces that point I made maybe in the first video about how classes are going to see the world completely differently. You're beginning to see you're seeing more evidence of kind of an ideological split between these two groups of people. Another thing is that this kind of logical argument for the social necessity of this kind of social relation in any society that uses money, I think, has to be seen as a major argument against the existence of money in any post-capitalist economy. If you have a post-capitalist economy and you need that to be stable, then there is no place for the capital social relation. And if there's no place for the capital social relation, then you can't be allowing things like this to form. So that's, I think, an important argument to kind of take away from this. So this isn't a completely abstract thing I'm talking about. There's a lot of consequences to this observation. Now, that's not to say that something similar to money might not have a place in a post-capitalist distribution system. It's just that you're going to have to look really closely at what the functions of money are that are producing this capital social relation, and try to make sure that it's not happening, that you don't have something like this forming. So you can have a discussion about direct labor accounting with computers and labor notes and all sorts of stuff like that. But this is the beginning of that conversation, I think. But keep in mind that this MCM thing actually has nothing to do with production. From the perspective of the banker, they don't really have any concern with production. And so the last thing that I kind of want to conclude from this is I want to use this as a bridge to start to talk about the subdivisions that are going to be occurring within the capitalist class itself. So up to now, we've been assuming essentially that every capitalist we've been talking about is an industrial capitalist. They're people that are making things. They're people that are hiring workers and buying materials and actually conducting a production process. In comparison to that, the finance capitalist is a very different animal. They don't care at all about production. They see their profits as starting and ending with money. They give out the money and they expect the interest back. They don't really have to care about production at all. They don't even have to really know where their profits come from. They don't have to understand any kind of theory of where their profits come from. They just want their money. The industrial capitalist is, of course, money-driven too, but they understand that their ability to profit is dependent on the ability to continue the production process at all costs. The imperative of the industrial capitalist is to reproduce the production process. They have to keep their factory operating. They see their profits as being basically derived from the continued operation of their factory. Whereas the finance capitalists, they see their profits derived by the continued circulation of their money. And so that's a very different way to look at the world. And then finally, there's a third kind. We haven't really talked about this, and then we're not really going to that much. But basically, a merchant eventually is going to enter the scene. There's another division of labor happening. We've got a capitalist that's kind of managing the production. We've got a capitalist that's managing the money. But now a merchant is going to walk in, and they're going to offer something to the industrial capitalist. They're going to offer to make sure that the industrial capitalist's commodities are made, are taken to the market and converted into money in a timely manner. So the merchant, the commercial capitalist sort of acts as like an insurance salesman to the industrial capitalist. They go up to the industrial capitalist and they say, we know that you're worried that your finished products are going to have some trouble being converted into money to be converted into raw materials. We can offer you guarantee that your finished products will be converted into money in a timely manner so that you can continue your operations, even if we have to take a hit. All we ask is that some of your profits are siphoned off and given to us so that we can profit as well. And so the commercial capitalist thus becomes its own actor, and they see their profit as deriving from the flow of commodities. So we have the industrial capitalist who sees their factory operating. We have the finance capitalist who sees the money flowing. And we have the commercial capitalist that sees the goods flying around. They're seeing very different things, and they're seeing their profits derived from very different places, and they're not always going to be getting along. And so we're getting these three forms of capitalist, and these three forms of capitalist are corresponding to the three forms that capital takes in the circulation of capital. Essentially what we're doing is we're breaking down the circulation of capital into three sub-circulations: the circulation of money, the circulation of industry, and the circulation of commodities. These are all different circulations, and all three of them kind of unite to form the overall circulation of capital. So let's return to Marx's diagram to make sense of this. So I've extended out Marx's kind of diagram for the process of capital a few steps to kind of make clear the kind of three different kinds of capitalists that we sort of have. So the industrial capitalist is who we've been talking about. We've been kind of centering this thing around money, but really, from the perspective of the industrial capitalist, their goal is to keep production going, and they just expect a profit from doing that, right? And so they see the reproduction as the reproduction of production, right? P to P prime. So this is what the industrial capitalist sees. So that's the industrial capitalist. The finance capitalist, on the other hand, sees the circuit that we kind of started with, M to M prime. That's the finance capitalist. And then finally, the commercial capitalist, they see C to C prime. They see this final batch of commodities that the industrialist makes, and they do something with it, and then they go back to that guy, and then they hopefully get commodities again. And so their capital circuit looks like C to C prime. So we've got these three kinds of capitalists, and these capitalists see capital, the capital social relation, as a completely different thing. Each one of them sees the social relation of capital differently, and they're right to do so, because these are, like I said, three different circulations. The circulation of money capital, the circulation of industrial capital, and the circulation of commercial capital are initially all one and the same, but they will become kind of divorced of each other as time goes on and capitalism develops. And we already started to hint at that when we talked about the commercial capitalist and what he's offering to the industrial capitalist. Remember, the commercial capitalist says, I'm going to make sure that your commodities get exchanged for money, and I'm going to make sure of that by just giving you that money outright. I'll worry about selling them myself. You don't have to worry about that. I'll just buy the stuff from you, and then I'll worry about selling it. Meanwhile, the financial capitalist is doing the same thing to, let's say, the merchant. The financial capitalist is going up to the merchant and saying, you don't even need to worry about selling your stuff. I'll give you the money in advance as long as you sell it later. So what we're seeing is like a dechronologizing of this thing, a kind of delinearizing of this thing happening. These three circuits are kind of separating from each other over time. And what that really translates to in real terms is it translates to capital circuits continuing on the assumption that things will eventually happen. That's what's really going on now. The industrial capitalists can continue their operation on the assumption that their produce will eventually be sold in the market. They don't have to necessarily sell it in the market immediately in advance. So what you're seeing here is that, like, on the one hand, what we're seeing is that the capitalist class is dividing up the quote-unquote labor so as to streamline this process of capital, so that if there's, say, a problem in the market, then the industrial capitalist doesn't have to immediately have their flow of capital broken, and that gives the whole capitalist system time to kind of undo whatever knot is kind of accruing there. But you already know what I'm going to say is the on the other hand. On the other hand, what if the problem doesn't resolve itself? What if there's like a real problem with the way things are being done that is going to kind of prevent any kind of resolution, any kind of natural undoing of whatever knots there are? What if there's some kind of overproduction problem where simply lots of things are being produced that nobody wants and nobody's going to want? It's not a matter of people just not being able to afford them fast enough, but just simply that nobody's going to buy this stuff. What if there's a problem with the money supply? There could be problems in lots of different ways, but but with this kind of streamlining process, what's happened here is that any problems are now going to go undetected for a very long time. And that's the point. But it also makes it so that problems become crises. If there's a problem with the circulation of capital, what you're going to essentially ensure by this streamlining of the process, you're going to get everything that is a problem with the capitalist system being exacerbated. And this only will get worse as capitalism develops and streamlines itself more and more. And so this process by which potential problems become potential crises, I think, was important to talk about before we get into talking about crises. But it's also worth noting that capital itself has three different kinds of circulations. The capital takes three different forms during this whole process, and that creates three different capitalists, three different kinds of capitalists that might all not all get along and might have conflicting interests with each other. In fact, it's generally going to be the case, of course, that one of these types of capitalist is dominant. And in fact, as capitalism develops, it's actually probably going to become the case that a natural hierarchy forms. And to understand that natural hierarchy formation, we need to understand what the capabilities of these three kinds of capital are. I think the big difference in capability between these three forms of capital is a matter of mobility. And I think that Marx's kind of language and kind of illustrative kind of language that he uses of metamorphosis, like capital as a metamorphosis process, is very helpful here for understanding this. I think this GIF is very good to see it, right? Money kind of flows in, and it's very immobile until it flows in, and then it becomes a cocoon. And that cocoon process is when the production is happening, right? Production, you can't really move around. Money capital is very mobile. It can go anywhere it wants, and it can go anywhere it wants very fast. Industrial capital, on the other hand, the production process is pretty difficult to move, right? Just think about the Rust Belts. Just think about, like, the Rust Belt cities, right? They just kind of got abandoned. It was so difficult to move those factories that they just got abandoned. It's uniquely immobile with the productive capital, the industrial capital. And then the commodity capital is also quite mobile, but it's not as mobile as money. I think this GIF sort of missed an opportunity to illustrate that. What it should have, I think, had is commodities kind of climbing up as a caterpillar. I think that in terms of mobility, commodities are the caterpillar, and then production is the cocoon. I don't like that they have the cocoon labeled C there. The cocoon should be labeled ... P ... The cocoon is the productive process. It's the least mobile part of the whole thing. And then money, I do agree with them having money as like the thing flittering away. It's the butterfly that comes out of the cocoon. And you have a clear hierarchy of mobility there, right? At the bottom you have industry, you have the cocoon. Above that you have the caterpillar, and then above that you have the butterfly. And so it's pretty obvious that if you're a financial capitalist, that gives you a distinct advantage over the other capitalists. You have the most mobile form of capital. That's what you're operating with. And so I think that you're gonna get a natural hierarchy within the capitalist class between these three capitalists. I think it's pretty clear that just because of the natural mobility advantage of money capital, the financial capitalists are going to kind of be at the top of this hierarchy, with the commercial capitalists below that, and with the productive capitalists, the industrial capitalists, below that. And I think that this is pretty true to this day, right? Everybody knows how much power the banking institutions have. Not only that, we can think very clearly about, we know people's names that are the big name in commercial capitalists, right? Everybody knows who Jeff Bezos is. Everybody knows who the Walton family is. But how many industrial capitalists do you know the names of? How many factory owners, how many captains of industry in that sense have you heard about lately? You really probably haven't, because they are subservient to the commercial capitalists, right? Nike has like a giant network of shoe producers all over the world with different names. And those shoe producers are all subservient to Nike, right? Same thing with the banking institutions, sort of, to a lesser extent. I think the banking institutions are going to have a perpetual kind of battle for dominance with the commercial capitalists. But the bottom line is, I think you do have this hierarchy in terms of mobility. And I think this has big implications for geopolitics too. Just think about, China. China's where all the production is going on, right? I mean, or Southeast Asia in general. Production is kind of centralized in certain parts of the world. Finance is kind of centralized in other parts of the world. So there's big geopolitical implications to this kind of a hierarchy. I think you're going to see countries where, depending on their situation in terms of what the purpose they serve in terms of the overall global circulation of capital, that's going to have a big influence on, I think, the hierarchy of power with politically between those countries. And I should be clear that I'm only claiming a hierarchy of advantage. I'm not saying that at any point in history you won't find industrial capital dominant over the other two. In fact, I would say that capital's beginning was that situation, and for all we know, with China on the rise and so forth, that might still be the case again soon. But there is a clear advantage that is normally just in terms of mobility. On the side of finance capital, and followed up by commercial capital, and followed last by industrial capital. One final thing I should probably address before moving on is there is always controversy regarding the people that are doing wage labor for the commercial and financial capitalists, of which there are many. People who are new to this theory, I think, have a tendency sometimes to say that these people are not actually workers because they're not productive. I should have people recall that having the labor be productive, as productive of value, never had any place in my objective or subjective definition of what it meant to be a worker. It has nothing to do with that. So yes, there might be workers whose labor is not strictly productive in the sense that we've been talking about it, but that does not mean that they are not a worker, and that does not mean that their class interests don't align with the workers doing quote-unquote productive labor. And it also doesn't mean that their work isn't valuable. Our definition of value is formal, and so it has a very particular meaning. It is valuable in the sense that capitalism values it. It is valuable in the sense of commodity production. So again, this is also not making a moral or normative judgment on what kind of labor is valuable. It's not productive of value, but it can still be valuable. And so again, it's not a word that should be offending anybody. So I'm not going to get into the extremely painful discussion of what is and isn't productive. They are workers because they are experiencing the same exploitation as other workers. They are doing labor, and that labor is not coming back to them. And you can argue about how much more or less their labor is going to themselves. But I think that, again, this is an experiential category. The feeling of alienation is not explicitly definable mathematically. If you are selling your labor power for wages and you feel exploited and you feel like a worker, then you are a worker. That's all it means. So to call labor unproductive is also not something that should offend anybody. This is it's a little hard to get across people if you haven't brought them to this point, but I think people get it. So this is turning into a full-blown summary of Volume 2. for some reason. But on that note, I think the next thing to move on to logically is probably one of the more underappreciated elements of Marx's overall argument, which is turnover cycles. So capital circuits take varying amounts of time to complete. We've been talking about like the overall circuit of capital, the M to N prime, but we haven't really talked about the amount of time that has to pass in order for one of these circuits to complete. And so the total amount of time for, say, M to go to M prime, or for C, or for P to go to P prime, or for C to go for C prime, this amount of time total is called the turnover time of capital. And you can break turnover time down into a few different segments. The first way to break it down is to break it down between production time and circulation time. So within this kind of circuit of capital, we have a couple different kinds of time that's being used. So there's obviously the production time, which is like from here to here, when production is happening, right? But then we've also got the circulation time. The circulation time is the time when the product needs to be kind of, as is in a commodity form, it needs to turn back into a money form, or is in a money form, it needs to turn into a commodity form. So basically from here to here, this is basically, I mean, this is a long circuit of capital. So really, if we're looking at one turnover of capital, we're really looking at one M to M prime right here. And of this like total amount of time, these two portions of it are circulation time. And then this portion right here is production time. So that's the idea. And the total amount of time when you add these two together is the turnover time of capital. But that's not the only way to divide it up, because within the production time itself, there are active and passive periods. There's active and idle periods. There are periods when the workers are actively laboring and adding surplus to the product, and then there's times when they're not. Like, for example, think about farming. With farming, there's a lot of work to do, there's a lot of labor to do, but then there's also a lot of sitting around and waiting. And that time does factor into this chronology. We haven't really talked about it yet, the idle time that you have to wait, but there is like a necessary amount of waiting. Not to mention, if this production time goes on for more than one day, like one work day, which it probably does, then workers are going to go home and go to sleep. So within the actual productive period, I'll just kind of divide it up like this, where maybe I'll put all the production here, and then I'll put all the circulation over here. C for circulation. You have certain periods of it that are like periods where the workers are active, and then periods when they're not. And so we can divide that up too. We'll call these periods the working periods. So this is working time. So you have working time within the production time, and not all of the time within the production time is working time. And so you've got kind of three different kind of periods of time during this like circulation of capital overall. You've got production time, which is either working time or idle time, and then you've got circulation time. And the reason that this is significant to us is, obviously it's significant, this is kind of a pretty fundamental thing, but let's suppose that the turnover time for a capital is 1 year. And let's suppose that the rate of exploitation is 1. So, same amount, if the capitalist purchases an hour of time, they get an hour of time for free. And that the capital kind of has a size of 500 plus 200, 700, like 500 in constant capital, 200 in variable capital. Then the rate of profit for that year, if the turnover time is a year, is this, right? It's 200. That's the S, because you pay 200 for variable capital, so you get 200 back in surplus over the size of the capital, the amount of time that's required to kind of keep this profit train rolling, which is 700, and you get 2 7s. So let's suppose that we bring this turnover time down. Let's suppose that technology and organizational advances bring this turnover time down to half a year. So we bring it down by half. Now it only takes half the time. Maybe that involved reducing the circulation time. Maybe that involved reducing the production time. Maybe that involved reducing working times. Who knows? But one way or the other, we reduced the turnover time down all the way down to half a year from 1 year. So at first glance, given what we've talked about so far, it wouldn't seem like this really changes the rate of profit, because we've been sort of thinking about the rate of profit on like a daily or hourly basis. We've been sort of thinking about like the capital required to keep a worker occupied for an hour. But if you're thinking about the profit rate as a capitalist, you're basically thinking about like the daily or annual profit rate. Essentially, what we've been doing this whole time is we've been assuming that all turnover cycles for capitals were the same length, which is exactly 1 day. And in that way, we were making no distinction between the capital applied and the capital advanced. But when you're thinking about turnover times, that does become crucial. And the reason that becomes crucial is when we're talking about operating capital, we're talking about keeping the operation going. In order to keep the operation going for 1 year right now, it requires this much capital. But if I reduce the turnover time by half, if I only need half a year now to do it, then I can use up all this capital and complete 1 turnover cycle. If I've completed 1 turnover cycle, then I get this capital back, and I can recycle it. And so the operating capital for the whole year remains the same. I can just do 2 turnover cycles. I can do 2 turnover cycles for the price of 1. Because I can recycle this capital, I get that capital back, and then I can use it again. I don't have to forward any more capital. I don't have to advance any more capital to keep this going. I just get more out of it. And so now I'm getting 400 in surplus value, whereas before I got 200. And so because of that, my rate of profit has actually increased. It's gone from 2/7 to 4/7 because I'm getting double the surplus back because I can just recycle this operating capital because it comes back to me because the turnover has completed. And so this is a brand new way that we didn't mention in the last video to increase the rate of profit, is to reduce turnover times. And so to reduce turnover times requires, in one sense, something we've already talked about. We've been sort of talking about reduction of turnover times strictly in the sense of reducing working times. We've been talking about that quite a bit. But there's other ways to reduce the turnover time, right? Because there's 2 other kinds of time. There's the idle parts of the production time, and there's the circulation time. And to decrease either of those is to increase your rate of profit because you get capital back to recycle faster, and you can complete more turnovers with less capital. So on that note, let's think about some of the ways that you can do that. So raising production times overall, as a to increase working times, is to do all the stuff that we've been talking about up to now, right? Hitting the laborer with a whip, making fancy machines and so forth, right? So I think what's most important about this turnover time stuff, to me at least, is the way that it explains a lot of the technological advances that capitalism has kind of created over the years that we haven't been able to explain yet, given our what we've said so far, right? Some kinds of technological advances have been explained already, right? We understand now why we keep making more and more fancy machines that can print out the stuff faster and faster. We understand now why there's technology to monitor people and make sure that they don't take too many bathroom breaks. We can understand certain technological advances, right? All the technological advances which reduce working time, we can understand now, and enforce labor discipline. But there's other kinds of technological advances that capitalism has provided, and those technological advances tend to be the stuff that reduces either the idle time implicit to production time, or reducing circulation time. This one is the bigger one, the circulation time. So before we get to that one, let's talk about production time. Actually, before we even talk about that, let's talk about the fact that we've noted now that the longer a turnover is, the lower the rate of profit, which explains actually on its own why certain technologies simply haven't come into existence. Most notably, lumber. Marx talks about this actually in Volume 2. He talks about how capitalism was going to have a tendency to deforestation, because the turnover time of growing trees and harvesting the lumber to sell that way is just simply too long. That turnover cycle is way too long for any capitalists to bother with it, and so nobody's going to bother with it. Hopefully that changes soon as we realize we have to plant a whole bunch of trees to suck up some of this carbon in the air. Hopefully, China's cooking up some interesting like CRISPR technology with fast-growing trees and stuff like that, and super sinky carbon soaking up trees and stuff like that. Hopefully we get some cool tree technology soon, but capitalism has not created that for us. The impetus for it simply hasn't been there. If you don't have the industry to begin with, you're not going to get a bunch of scurrying to speed up the circulation time or the turnover time of that industry. So that's one thing to note immediately. Another thing is, let's think about what reduces production times, what reduces the idle time, right? And I don't know a whole lot about like the technologies, but I can easily imagine them, right? Selectively growing your crops to pick the ones that grow the fastest, right? Special fertilizers. These are things that would decrease that idle time. If you want to, and I'm sure there's all sorts of screwed up advances in animal domestication technology, right? Ways to create mutant, pigs and sheep and stuff that can provide what they are meant to provide, or what they're being bred to provide faster and in greater amounts, right? Do weird stuff to your animals. I'm sure that you could do all sorts of research and see what the impetus to decrease production time has created, the monstrosities that has created over the years in terms of domesticated animals. Now, as far as circulation times go, that's super easy to see. Planes, trains, and automobiles, communications technologies, just-in-time production, containerization. Actually, just-in-time production, I should probably wait and talk about that. That arises in a slightly different way. This is a little more complicated. It's not clear why just-in-time production would reduce circulation time. In fact, it doesn't. This is its own thing. Let's kind of put that in a bottle. But anyway, this is actually, Marx calls it in the Grundrisse, he refers to the reduction of circulation time as the annihilation of space by time, because capitalism as like a force tends to measure space in terms of the amount of time that it takes to get across it. Because when we're talking about circulation time, one of the biggest things that we're talking about is transportation technology. The faster you speed, and so you speed up the communications and the transportation times, then you've reduced circulation times. And so this has been one of the biggest, technological impetuses within the capitalist mode of production. Super fast planes, super fast cars, build big highways, and the communications networks are a huge part of that as well. The ability to quickly communicate is implicit to, a shrinking of the perception of space. So it's a really strange kind of effect, kind of knock-on effect here that you get, which is that since capitalism measures space in terms of the time it takes to get across it, it's going to try to reduce that. This is called speed up. So speed up is a very important kind of idea that you get out of this, the reduction of circulation time. Space tends to feel smaller. I think you can make the argument that space literally feels smaller to you and me today than it did 100 years ago to other people. When I think about going across the world, I imagine that I can be there tomorrow if I wanted to. That's not something that you could have said before capitalism, right? Containerization is another really big one. You can just kind of take the container and load it onto the thing, and then take it off. And organizational advances in general can reduce circulation time a lot. I don't want to get too far into this. This is already kind of going on an hour. But, you get the idea. You can imagine all sorts of technological change that you're going to get under capitalism, in the attempt to reduce the circulation time of capital. And then another thing that I thought of when I was saying this out loud is, to reduce circulation time, one is to reduce the transport time, but you also want to make sure that you're reducing the time that it takes for people to buy your stuff, to how much time does it sit on that shelf? If you, and that basically I think is the impetus for a lot of the big data technologies, right? Knowing when people are going to come buy stuff and pick up on the shelf. Algorithms. You're going to get a lot of algorithmic prediction making technology out of this, right? And then you're also going to get massive innovation in advertising, because advertising, what is it if not the production of consumption? You're going to get attempts to technologically innovate in the sense of conditioning people to get products in a certain kind of reliable and faster and more and in a higher volume manner, right? You're going to try to take measures to make the population consume more and consume more reliably, consume faster, etc. The production of consumption, I think, is another implicit thing that you get here, maybe, that you could argue that you get here from this impetus to reduce circulation time overall. So the next thing I want to talk about regarding turnover is this contradiction that emerges between idle capital and breaks in continuity. Both of these things are things that the capitalist wants to avoid. And by breaks in continuity, what I really mean is once your capital circuit turns over, once it completes, once you go from M to M prime, you don't want to wait any bit. You don't want to wait before you start this over again. Anytime that you wait is idle capital, right? You don't want to break in continuity. You want to start things over immediately. And so let's say I'm a productive capitalist. I finish making my product. I don't want to just wait for my product to turn over and take back, go back into like a productive capital form, like labor and means of production, before I can start things over. I want to be ready to start things over immediately. I don't want to have to wait for that circulation period. And so that's what I mean by breaks in continuity. And so if you want to avoid breaks in continuity, then the thing you have to do is obvious in some sense. What you have to do is you have to hoard. If I'm a productive capitalist, then I have to hoard one of two things. I either have to hoard money capital or I have to hoard commodity capital and have it on the ready to start the production process again while I wait for my finished goods to circulate. And there's a tendency here, regardless of the kind of capitalist I am, I have to do some of this hoarding. And if I'm a capitalist, I probably have multiple kinds of capital, invested in multiple ventures at once. And I have a choice now. What kind of capital do I want to hoard? Do I want to hoard commodity capital? Do I want to hoard money capital? Do I want to hoard, do I want to have production going somewhere else? And the answer is pretty much always going to be money capital. And we know why. It's going to be money capital. People are going to be hoarding money capital to continue their production, if anything, because money is the most is the quickest. Money is the most mobile. I can use it in the most ways. Why would I not keep the universal commodity? Why would I keep a bunch of fuel when I could keep money that I could just spend on fuel? I can do anything with money. And so if I'm going to hoard anything to keep continuity going, then I'm going to hoard money. But there's a contradiction here, because if I'm hoarding things, if I'm hoarding money capital or commodity capital or really anything that I'm not using, then that's idle capital. That's not capital anymore. Capital is money, is this stuff in motion, right? It's the flow. If I'm hoarding something, then I'm hoarding things that could be used as capital, but they are not currently capital. They're just sitting there. And so to avoid breaks in continuity requires an accumulation of idle capital. And so we have a bit of a contradiction here. And so we have, and what this contradiction leads to is a different kind of technological dynamism. What we get is innovations such as what I mentioned before, and I decided to delay, just-in-time production. Just-in-time production was an invention that an organizational kind of invention that was created to avoid any kind of hoarding of commodity capital. People didn't want their commodity capital to be sitting there, so they came up with organizational systems based on computing technology and so forth to make sure that nothing was ever sitting anywhere. Everything was showing up exactly where it needed to at exactly the moment that it needed to, and so therefore nothing is ever not in the capital process. And so you don't. So just-in-time production is to avoid having either of these things, either breaks in continuity or idle capital. We need to avoid both, and that creates its own technological kind of dynamism. I mean, it used to be that your local grocery store had like a giant stock of things in the back room that they would just kind of put back on the shelves, each day. But that's no longer the case because of just-in-time technology. Now there's almost nothing in that back room, and you've just got like goods kind of arriving each day. With predictive algorithms kind of figuring out what it is that people are likely to be wanting to get that day. So that's an emergence, a recent emergence that you can understand through this discussion of turnover. However, as money capital, this gets even more interesting. And I'm staring at these numerical examples here, and I think I said everything honestly that needs to be shown that I was trying to show numerically here. I don't think I need to show anything numerically here. All I was showing here is that the capitalist has to keep some money on reserve to keep production going and to avoid breaks in continuity, which I already said. The bottom line is that we've addressed the kind of avoidance of commodity capital that gave way to stuff like just-in-time production and organizational methods and containerization and stuff. For capital sitting idle in the money form, what do you get? Well, you get yet another reason why we have banks and reason why we have a credit system. This is yet another kind of, it's kind of interesting as you read Capital, you see Marx come up with like 78 different reasons why the credit system becomes a social necessity, why banks become a social necessity. And we've already seen kind of one of the main ones, I think maybe one of the most important ones, which is to resolve that contradiction between money as a measure of value and money as a means of exchange. But here you see that it's existing now to resolve a completely different contradiction, that between idle capital and avoidance of breaks in continuity. Banks now exist essentially as the common capital of the capitalist class. If you don't want your money to sit idle, what do you do with it? You put it in a bank, and then that bank will make sure that it returns interest, right? That bank will make sure that it is being used somewhere in some capital process as a loan to somebody to do something. That loan is now, that money is now in use, and so that's another reason why banks exist. And I think it colors in more what the character of these banks is going to be in a capitalist system, in a for-profit system like this. So at this point, I want to mention something that I think doesn't really get broadcasted enough as a consequence of the 3 volumes of Capital. It's talked about more in like the Communist Manifesto and stuff. But we've kind of talked about 2 tendencies that kind of go together to give you this kind of cosmopolitan character of capitalism. One of those is the kind of tendency within capitalism to overproduce. We've seen that in a variety of ways, and we're going to see it in about double the number of ways that we saw it already in the coming slides. But there's an implicit tendency to overproduction in the capitalist system, and we've also seen that this problem becomes particularly acute in the case of wage and consumer goods. Who is going to consume the stuff? Who is consuming my end product? It can't be the workers. I don't want to pay them more. And we also understand now that as this problem builds up, we now have this associated kind of technological dynamism, which is making it seem like I can get around the world faster. And you can see exactly what comes out of this. One of the major ways to, how do you find new consumer economies? Well, you do colonialism. You go somewhere else. And so you can complete the puzzle here and kind of infer that one of the emergences of a capitalist system is the world market. The historical mission of the bourgeoisie is globalization. To quote the manifesto, the need for a constantly expanding market for its products chases the bourgeoisie over the whole surface of the globe. It must nestle everywhere, settle everywhere, establish connections everywhere. We've seen that now. We've kind of shown that logically. And like we're noting more and more times, this economic kind of fact, this kind of material process is giving way to ideological consequences. And the ideological consequence in this case is a growing sense of internationalism among everyday people. You feel more connected to people across the world than you ever did. I have people that I communicate with on a daily basis that are in Bulgaria, that are in France, etc. And this Marx considered very important to, the creation of socialism. He imagined that this growing sense of internationalism would allow for an international workers' movement that could kind of upend all the old stuff. And by old stuff, I mean the nationalism that kind of preceded and came with capitalism. Nationalism, I think, is a much more complicated ideological force in terms of its origin and role. But nonetheless, we kind of had nationalism along with capitalism. And we have this idea of like a country that exists as like a national entity. Within a capitalist system where each of these national entities is dominated by their own national bourgeoisie, these international bourgeoisie are all in competition with each other because there is no national capitalism. There's only an international capitalism. So these national you get basically the competition between capitalists as monopoly forms becoming a competition between states, between countries. And so you get this growing sense of nationalism along with and competing with this growing sense of internationalism. You get this really interesting tension between the two. These two ideological forces are going to have it out, and one of them is going to win. And I think that battle between nationalism and internationalism has been somewhat defining of capitalism's history up until now. And so I want to wrap up this whole video on the circulation of capital by talking about kind of the central kind of categories of capital to circulation itself. When you're talking about production, the major kind of breakdown of capital is between constant and variable capital. But when you're talking about the circulation of capital, when you're talking about capital as the social process, the breakdown is a little different. The more important kind of distinction is between the fixed and the fluid. That is to say, the capital that is circulating, the capital that is like, the raw materials that I'm using as kind of fuel that I'm processing and then buying more of every single cycle. And then the other things that are like machines and boats and infrastructure that can be used for multiple turnover cycles. There's a lot of capital that gets used for multiple turnover cycles and gradually deteriorates. Buildings, boats, railways, communication networks, giant factories and machines and so forth. And capitalism tends to provide an immense accumulation of this. I think that one of the things that Marx maybe intended to show in Volume 2 but didn't quite show, at least I don't remember him showing it that well, but I think he kind of was thinking this, is that one of the consequences of a reduction in circulation time, or that drive to do that, is an accumulation of fixed capital. That is to say, capital that is good, that is going to be used for the production of something else, which is going to be good for use for multiple turnover cycles. Now, the way that this fits directly into the labor theory of value is a little bit controversial. Marx proposes like a depreciation model where basically some of like the value from the fixed capital goes into every product that's created during a cycle of production until finally it's all used up. So basically like if you have a machine that's good for like 500 production cycles, then 1/500th of the value of the machine goes into the final product 500 times. That's kind of what Marx proposes. A more sophisticated proposition, which seems very messy, but I've heard works better, is to propose this kind of joint product idea where, like, the idea is that when you produce something, you produce actually two things. You produce the commodity that you were talking about producing, and then you also produce a new commodity that is the depreciated thing. You know, so again, if the machine works for 500 cycles, I have kind of 500 different commodities, which are all the machine at different levels of wear and tear. And so basically the output of the production process is the product and then also the worn out machine, like the newly worn out machine. And that's another way to do it. And that machine has less value. Now, there's a lot more that can be said about fixed and fluid capital, and I'll be completely honest, I'm not the person to say any of it. I'm really not much of an expert on this particular branch of Marxist thinking. But what we're headed towards with all this stuff is towards a discussion of crises and overproduction. And believe me, I am trying to get there. This has been a very strange video. I ended up saying a lot of things that I had no idea I was going to say. But in any case, the main thing for our purposes to note about fixed and fluid capital is fixed capital for a capitalist is extremely dangerous. If you get a machine, and the reason for this is technology, if you get a machine and this machine only gradually pays for itself, then there's a risk that somebody might make your machine obsolete before you've paid it off. Before you've gotten the full value of the machine, it might turn out to be the case that somebody's invented a better machine. The socially necessary labor time for the production goes below that, and you end up just, your machine is just worthless. You're losing money even using it. So again, what does this do? It incentivizes the capitalists to produce as much as possible. They get this new fancy machine, and you've got to use that machine up before some other capitalist invents something better. And so, again, what do we get more of? Production for production's sake. Make as much as possible, as fast as possible. Screw supply and demand, who cares? That's not the game here. The game is to make as much as possible, as fast as possible. And the more fixed capital there is, the more quickly fixed capital is developing in terms of technology, the more of an incentive you get to just kind of produce more for production's sake from that. So there's yet another reason right there. And so now we're finally kind of where I wanted to be. I think I've finally said enough about the circulation of capital that I can really start to talk about what I wanted to talk about, which is crises. And so I want to conclude the video with a discussion of what crises are. And in order to understand what crises are, we have to look at this diagram that we've kind of been staring at for an hour now. As a social process, it's a flow of activity in which a lot of different things are done, a lot of different objects are used in a lot of different ways, but at the end of the day, you have sort of a flow of a social process that kind of repeats itself. And capitalism is a mode of production in which you have a whole network of these that are sort of reliant on each other, a whole flow of flows that need to kind of, and every single one of them kind of needs to complete in order for the other ones to complete, right? If there's a, and so that's kind of what I'm getting at. If you kind of think about capital as like a flow, then you can sort of think of it as like a plumbing issue. If some kind of blockage is to develop, then the flow of capital stops. If there was to be some kind of point at which you can't go from C to M prime maybe, or you can't go from M prime to C, you know, if something goes wrong, if something prevents this chain from continuing, then you've stopped the flow of capital. And since capital is that process, you've stopped capital at that point. At that point, what does it mean for capital to have stopped? If capital stops, that means that people are just standing around. Nobody's making anything. And chances are very high that if you stop the flow of one capital, you stop the flow of many, because this finished commodity here is very likely to be going to be used by another capitalist. But there's a lot of different ways in which this flow can be halted. And just to kind of look at this and kind of point out a few, one of them that jumps out at me is this one right here, means of production, the raw materials that I have to get. You know, some of those raw materials are produced by other capitalists, but in the first instance, these raw materials come from nature. So if there's some kind of problem in nature that develops that prevents me from getting the raw materials, then that's gonna halt this whole process, and that's gonna create a crisis, because it's just gonna kind of halt all of the capitals all at once, or it could, right? It could cause a chain reaction. Another place in which you could easily get a crisis is right here. This is a very delicate location of the flow of capital, because at this point I have my finished commodities, and I need to trade them for money so that I can restart the process. But if I can't sell those commodities, then I've got a huge problem. I've stopped the flow of capital at that point. There's a blockage here. So this is basically the market. And we already saw how you could easily get crises of overproduction, especially if you're one of the capitalists that's making wage goods for the workers. Another place where you could get a blockage is right here, right? These workers, these are kind of scary people. Like, what if there's some union contract that's set to expire and the workers decide to go on strike to try to get something, right? Then production just halts. And this is a very special kind of blockage when you think about it. This labor, a blockage coming from here, this one is very special. Actually, this one is kind of special too, at least compared to this one. Because remember, I mentioned that we have this kind of streamlining process going on where you have capital splitting into 3 different circuits, where you've got the commodity capital circuit, the finance capital circuit, and the productive capital circuit. And I mentioned how this streamlining process made it so that these blockages could have some time to resolve themselves. But having time to resolve themselves is maybe a euphemism for not noticing that there's a problem at all until the problem has become a crisis. Labor, these two right here, these two input parts are kind of special in that there's no way to streamline them. I mean, unions kind of streamline them to the extent that they're doing class collaboration. But, if labor just decides to go on strike, or if nature just decides to go on fire, there's no amount of streamlining that's going to stop that from becoming an immediate blockage. Whereas the market, you can kind of have a situation where these kinds of issues in the market become crises based on the streamlining. But these two right here, labor and nature, these can create crises very, very quickly. So a crisis in general is a sudden interruption to the normal operation of capital. It's a situation where capital has been halted in its tracks. And since humanity relies on these social processes of capital to produce what they need to survive, I want to be very clear that these crises are genuine crises for humanity. It's kind of abstract when you talk about, like, banks going out of business and stock markets collapsing and stuff, but really, those are just side effects of the fact that everybody's standing around, nobody's making anything. The productive processes are not continuing, and so humanity is not making what it needs to continue to exist, and everybody's just confused. That's a crisis. I'm coming back in editing to kind of mention also that it doesn't really need to get to that point where everybody's just standing around and nobody's producing anything for it to be a crisis. It could simply be that you see that society is in a tailspin where that's about to happen. I think that that's probably the more modern take on what crises are. For example, that big financial crisis in 2008, it never got to that point. It was merely everybody saw that it was approaching that point and they did something about it quickly. That's also a crisis. So, my definition has to be kind of stretched to kind of include things like that, but I wanted to mention that. So the particular kind of crisis that we're going to be focusing on in all of these videos, we already have been and we will continue to, is the crisis of overproduction. What the crisis of overproduction is, and we've seen this already, and we're going to see it more when we get to the reproduction schema, which I've made some cool stuff for. I can't wait to show people. Is that the crisis of overproduction is extremely foundational to capitalism. It exists everywhere you look. Everywhere you look, you see this problem of overproduction. It's there. It's staring you in the face. Now, that's unique about it. But precisely because it's so foundational to capitalism and that it always has been, capitalism will develop around its own understanding of its own shortcomings. Every time that there's a crisis, capitalism will take measures to make sure that that type of crisis doesn't happen again. In other words, capitalism's entire history has been in response to trying to put band-aids over this crisis of overproduction, and then put band-aids over those band-aids when it turns out those band-aids weren't good enough, and then put band-aids over those band-aids over those band-aids, and so forth. So I'm going to make it seem in the coming kind of stuff that these crises of overproduction are inevitable. But the thing is that the only thing that's inevitable within capitalism is the crisis itself. I think that in order to understand crises, you have to start with the crisis of overproduction. But that is only the first chapter in a developmental story in which contradictions are deferred and expanded, and then you get the history of capitalism, starting with the crisis of overproduction. I think that that's really kind of how I view this. You have to start with it, but you have to also understand that it's not the only thing that there is to talk about. And in order to understand kind of the limited scope of the crisis of overproduction, let's look back at the circuit for just a second. I know people are getting sick of it, but just bear with me for just one more look at this. So let's think for a second about the why and the where of these crises of overproduction. The crisis of overproduction happens right here in the market. It's because you can't complete these circuits. You've got these finished products happening, and they're not being purchased, which can yield more money to restart kind of the process of capital. Well, I mean, all you really need is for that to happen. All you really need is for the capitals to be like provided with that funding. And so it's very, one of the natural ways to do it is to have a state step in and just kind of bail out these companies that have overproduced. Right? We've seen that plenty of times, is to either bail out or to subsidize. Right? That's another big thing that governments like to do. But this is but as a solution, what kind of solution is this? Right? In a world with fiat currency, that's just going to cause a ton of inflation because the government is just flooding the markets with cash that wasn't there before. Right? It just kind of made up more money to flood the market with. That's going to cause inflation unless you extort the rest of the population in some way through extra taxation or cutting of social programs or something, right? So, so the population bears the brunt of this kind of measure, and that's only going to fly for so long, right? So, I mean, you've deferred this crisis, but you've created the possibility of other crises down the line. And as long as you have kind of an exploitative system like this, I think that it's pretty inevitable that you hit a crisis sooner or later somewhere. So you can kind of think about the kind of crisis that we're going to talk about, these crises of overproduction, as like step one of like a process of a bunch of problems that a capitalist government is going to try to have to come up with ways to deal with, and through doing that is going to kind of steer capitalism into other crises, different kinds of crises. Another way to defer this stuff is what Rosa Luxemburg pointed out, which is, to avoid these crises of overproduction, to defer them, you do colonialism, you do imperialism. You go force somebody else to buy your product, find markets elsewhere in the world. But that has its own can of worms with its own issues. But I do think that in order to understand this whole history, you have to start with what's at the foundation. And I do believe that what's at the foundation of all of this is the crisis of overproduction. And so in the next video, we're going to look at the last major reason for that. And that reason is very simple. It is simply the anarchy of capitalist production itself. And so one thing that I've made, I'm really not sure what I'm going to do in the next video. I think what I'll probably do is I will do some math, and then I will show the reproduction schema through this software that I've made, actually, which is meant to illustrate what Marx was doing at the end of Volume 2, which is looking at the total circulation of social capital in the economy, the circulation of all of the capital put together. We've got all these capital circuits, and so in the next video, the logical thing to do, I guess, is to put them all together and to say to ourselves, what does the circulation of total social capital look like, and will the invisible hand of the market be able to coordinate that circulation in a way that doesn't blow up? And the answer is, obviously it can't. But let's see that for ourselves.